With all the turmoil in the markets, there is increasing interest in ETFs that provide downside protection. One strategy, known as buffers, use options to provide that downside protection. Let's talk with Brian Lake. He's the Chief Transformation Officer at Goldman Sachs. Also joining us, Mike Akins from ETF Action. Brian, Goldman, you just came out with a new buffer one last week. You have 3 of them. Let's not assume everybody knows what these products are. Explain to us how these buffer products work. What kind of protection are you getting? What are you giving up when you?
Let's start as an investor. I'm an investor, you're an investor, the folks watching are investors, and there's an incredible amount of uncertainty right now. Tariffs, the widening out of equity markets away from Mag 7, geopolitical issues. There's a lot of uncertainty. The buffer products are designed to help protect people to the downside while also allowing them to participate to the upside. Now, what we've done with this suite of products is the way they're designed is they'll protect from down 5% to 15% while still allowing you to participate upwards of 5 to 7%. And then those reset on a quarterly basis.
So you are protection from 5 to 15%. There's another protection 30% below that. It's sort of 2 levels of protection in this product. Then you participate in the upside up to 5 to 7. So you're giving up, if you do more than 7% upside, you're giving up that.
Yeah, the challenging market, which is the question I always like to ask, is what's a challenging market for these strategies? Straight up, right? A straight up market would be a challenging because you would be capped to the upside. But again, that's the cost of getting the protection to the downside, which so many investors are looking for in this market environment.
Right, so there's 3 of these that you had. You just had a new one, and they reset every 3 months, right?
Yeah, but that's an intentional design thing. So it's a suite of 3. Each of them set every quarter, but the way that we've staggered the launches is at any month, at the beginning of the month, you've got one of our buffer strategies that's resetting and ready for you to invest in.
So this reset date is very important. Again, let's not assume anybody understands this. It's important, we've said this before, to own these near the reset date and then hold them through the entire period. Why is that important? Explain to the viewers what happens with these.
So the market's going to move intra-month, but as we strike the options that are going into these strategies, they're the most precise for the outcomes that we're trying to design at the beginning of the month, because that's where we've priced it. Now, as soon as we go to day 2, the market's moved a little bit, and those hedges that we're providing, either that downside protection or the cap on the upside, is going to have moved a little bit. But if you enter at the beginning of the month, you should have it pretty set the way that they're designed. You can also go on the website and see exactly where we sit on any given day so that you can understand exactly what your outcome should look like over the next quarter.
Mike, you're sort of the grand ETF poobah around here. I have you here to sort of explain these a little bit more. Give us your general thoughts on these buffer ETFs. Are these valuable products? Talk us a little bit about how you feel about them.
Yeah, so I think first and foremost, I do think they're valuable products, but like all ETFs out there in the market that are going away from your true traditional beta, it's in the way that you use it and how you apply it to your portfolio. So, I always think of the Eric Clapton song that was in The Color of Money. It's in the way that you use it, in the sense that if you're properly understanding how the product reacts to your portfolio, and you know that, hey, is this a replacement to equity? Is this a complement to fixed income? Putting that in there and understanding your results, they provide a very unique way to get access to the market and really buffer away some of that downside that you might see in an ordinary course market like we're seeing recently. But there's key elements to this that really need to understand. I think Brian did a great job talking about it, but 1, how much protection are you receiving? 2, what are the reset months? Because owning it for the entire period of your reset is key because of that time element of pricing options. Recently, as we know, we've had a ton of market volatility, and markets have been down. Some cases that Qs was down 4% a couple days ago. A buffered ETF doesn't mean that you're not going to lose some of that 4% on the day it goes down %, even though it's in that protection period, because you have to hold it for the whole time period to get that full protection because of the pricing element of those options. That's really important to understand. So if you were to just turn around and sell it, you're not going to get that 2% or whatever protection that you lost on that one day of element. So that's really important to understand. And I think that's why you're seeing strategies like Goldman's becoming more popular, because instead of having to hold it for an entire reset period and having one strike price for that whole period, they're resetting on every month for a portion of the portfolio, giving you more of a smooth ride. You also see that in the laddered strategies, which are getting a lot of the flows. So from a viewer's perspective, if you're just looking to protect and you don't want to have to manage that where you're at with that buffer cap, both on the downside, look at the laddered strategies and the strategies that reset more often.
So just to review here, what you're doing with these buffer ETFs, you're trading some of the upside potential for downside, for reduced downside risk, essentially, right? So you allow to participate up to some level of the market gains, 5 to 7% on the S&P, you said, and then you use options to protect on the downside, essentially. And this resets at the end of every period here. In this case, every 3 months, right? Each one, there's 3 of them, right? So here's your basic summary of what's going on with these. So tell us about the risks and the considerations of investing in these products. I mean, obviously there's this market timing thing you were talking about. Tell us about the expense ratio. There's costs involved here, and your pricing options. Just give the viewer a sense of what's the risk here.
Yeah, I mean, these are importantly tried and true strategies that have been used by investors for decades now. And
the Goldman Sachs, sophisticated Goldman Sachs, the Goldman Sachs trading desk has been doing this strategy for decades, right? There's nothing radically new here. It's just in an ETF wrapper.
The innovation is that we're delivering it now through this ETF wrapper, which is so convenient for all types of investors to get access to. So there's definitely history around these. Now, we talked about one of the major risks, that if the markets go straight up, you could be foregoing some of the upside that you would be getting if you didn't have this option strategy. But that's kind of the cost of getting that downside protection, which again, if you think about where the markets are, historically, hitting all-time highs not too recently ago, or just recently, I should say, that's good. The expense ratio here, 50 basis points. So, we're really delivering these really sophisticated strategies, the ETF wrapper that's super convenient for investors to use at a pretty attractive price point.
So, what's interesting is that, and here we're listing some of these risks and consideration, the timing, the expense rate, 50 basis points, 0.5%?